Hello, and welcome to Hugessen's 2022 Proxy Season Review webinar. For those of you who don't know me, I'm Michelle Tan. I'm a partner with Hugessen in our Toronto office, and I'll be moderating today's session. So we want to start off and acknowledge that the land we're broadcasting from, or at least that I am from here in Toronto, is on the traditional territories of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat people. It is also home to many of the diverse First Nations, Inuit, and Métis people. We also want to acknowledge that Toronto is covered by the Treaty 13 with the Mississaugas of the Credit. I'm delighted to say that we have over 250 attendees signed up for the session today. And our audience does include a mix of both directors, management, as well as shareholders. And so for that, we've got a great lineup of content and insights to share. Joining me today are going to be Matt Downey, an associate in our Calgary office, as well as Kira Wakita, a principal in our Toronto office, who is part of our board effectiveness team, as well as Rami Glatt, a principal with Semler Rossi, our affiliate partner in the US, who's joining us today from New York. To help us navigate the next hour or so, we've divided it up into 3 broad content segments. And so first up, Matt's going to present the findings from our annual TSX60 Proxy Season Review, and Rami's going to give us a US perspective on the same content that we're looking at there. In our second segment, Kira's going to dig more deeply into some of the board effectiveness data that we've pulled out from amongst our TSX60 constituent review. And then in our third segment, we're going to cover off some of the emerging topics and hot trends that we've seen, not just over the last year, 2021, but more recently, sort of in the last 6 months as well. And we'll be discussing that, both Rami and I. And no fear, we have left time at the end of the hour to bring all of our panelists back together to answer your questions. So with that in mind, I want to get started with just a couple of housekeeping items. So you'll notice that all participants have been left into a listen-only mode for the duration of the webinar. And then questions can be submitted through the Q&A feature on the top left-hand side of the screen as the session proceeds. It'd be great to sort of get a sense of where your questions are as we go. We can help augment and sort of order them when we get to the final segment. And then as well, let you know that today's slides will be shared with all participants, along with our 2022 TSX60 briefing in the coming weeks. All of the materials will be available for download under our website, under the resources tab, once they've been published as well. And with that, I'm going to hand you over to Matt.
Thanks, Michelle. So hello, everyone, and thank you again for joining us. As Michelle mentioned, I'll be giving a brief overview of the results of our analysis of the 2022 proxies among the TSX60 constituents, and then I'll pass the mic to Rami to provide a US perspective. As the data and findings will show, fiscal 2021 was a strong year for compensation and performance, which is likely driven by a recovery from the COVID-19 pandemic, as well as increasing commodity prices for some sectors. So an important consideration before getting into the findings is to understand the general performance context. So as I just said, in 2021, there's very strong performance for the TSX60, but as we're all aware, this has come down a bit in the first half of 2022. This trend is kind of mirrored and exacerbated when looking at the NASDAQ, which clearly shows the strong decline in US markets in the first half of 2022, particularly in the technology sector. However, the Canadian energy sector has shown incredibly strong performance throughout 2021 and even year to date, coming off of the momentum of a COVID-19 recovery, as well as the increased commodity prices. This is in stark contrast to 2022, where Canadian energy lagged all other market indices because of a slower recovery, as well as deflated commodity prices. So this slide takes a bit more of a granular look at performance among the TSX60 constituents, the top chart showing the 2021 total shareholder return for the TSX60, and the bottom chart showing the same for 2020. Now, there's a notable divide for 2021 among companies in the resource sectors. Energy companies saw an overwhelmingly strong returns throughout the year, especially compared to 2020, and materials typically saw weaker performance than in 2020. Though still positive in most cases. The point is further driven home when looking at the top and bottom performers of the index year over year. So in 2021, the top 3 performers were all energy companies, and 2 of the bottom 3 were materials companies. Compare that to 2020, where we see that the top 3 performers, 2 of them were materials companies, and all 3 of the bottom performers were energy companies. Taking a more general look instead of just industry specific, the biggest takeaway here is you can see a greater proportion of constituents had positive returns in 2021 compared to the year prior. Moving on to actual pay levels, here we see the 2021 year-over-year median increase by total direct compensation by industry. So TDC is the base salary, the bonus, and then any equity grants for the year. And we look at both target to see what was kind of expected in a normal course plan versus actual, so we can get a better understanding of things. Looking at the TSX60 as a whole, while target TDC increased by only 2%, the actual TDC increased by 12%. It's not shown here, but it's also important to understand that the variability of pay remained relatively flat year over year, meaning that the 75th percentile year over year only increased about 2%, and the bottom quartile only decreased about 6%. Of all the sectors analyzed, those being financials, energy, and materials, and we only chose these 3 due to data availability, we saw an increase in year-over-year actual TDC, with the most modest increase being in the materials sector at a 7% increase, and the largest increase in median in the financial sector at a 22% increase. It's also worth mentioning that when looking at target TDC for the industry seems quite significant, this is actually mostly due to our methodology of calculation, as well as the sample size. So any small fluctuations paired with a foreign exchange rate, as well as there just not being too many companies available, usually n equals 8. It just means that median was more susceptible to actually moving in a significant way. If we looked at the average for the energy and materials, we would see that the target pay only decreased 1% and 2% respectively for the energy and materials sectors. Now, this slide shows the actual CEO pay for the last 5 years, so 2017 to 2021. Across the board, 2021 was a year where median CEO pay was largely increased from the previous years, setting recent record highs. As you can see, from 2017 to 2018, there wasn't much movement if we look at the 5 bars on the left showing all TSX60. These trends are kind of amplified as we move to the next 5 bars and then the 5 after that, which shows the same incumbents and same constituents. So just ensuring that it's either the same CEO kind of year over year for the last 5 years, or at least the same company. As we can see, there's much larger increases in pay year over year, being 17% and 22% respectively. Again, this is not necessarily unexpected, as performance in 2021 was very strong, especially compared to 2020. So we'd see that actual pay usually paid out through a bonus, and strong corporate performance would lead to these stronger payouts. Kind of building on that point, we show the actual versus target pay here for 2021 as well as 2020. So target pay is shown in orange and then actual pay in blue. Here we see that for 2021, there's a 10% difference between the actual pay and target pay, measured as total direct compensation. Whereas in the year prior, things were relatively on par. Again, this just reinforces what has already been said, that 2021 was a very strong year for most companies. Lastly, here we show the total actual compensation, again as TDC, for the top 5 NEOs that are disclosed in the proxies. The hanging bars on the right represent 2021, and as we can see, the variability among the shoulders of P25 and P75, so the bottom of the blue box and the top of the gray box, has increased, but the actual median has only increased slightly at about 3%. Additionally, on average, the CEO pay makes up about 40% of total pay to the top 5 NEOs among TSX60 companies, and this is exactly in line with what we saw in 2020 as well as 2019. Lastly, on the right here, we show CEO pay as a multiple of NEO pay. And what we can see here is that there's not much change year over year, which implies that the CEO pay hasn't grown at a pace higher than the other NEOs. So for example, the CFO, CEO makes about 3 times as much as the CFO in these examples in both 2020 and 2021. With that, that's the end of our kind of high-level pay level discussion of the TSX60, and I'll hand it over to Rami, who will discuss what the US market is seeing.
Thanks, Matt, and appreciate you all including me here today. Turning to US pay trends, we saw activity in 21 that largely mirrored that seen in Canada, albeit with some nuances. Specifically, executive pay levels continue to increase, and especially among high-growth technology companies. Looking at the numbers, the median S&P 500 CEO pay increased by 5% in 21, and that number was 12% in the tech sector, which continued to outpace the broader market. One interesting aspect of these increases was the distinction between cash and equity, namely that cash levels generally decrease. So we saw a median salary reduction of 2.5%, bonuses were down 9%. And this was as companies continued to feel the impact of the pandemic on annual cash pay. Equity grant levels, on the other hand, increased, which in many cases was an intentional means to help offset the 2020 reductions in actual pay outcomes. Now, I think it's important to keep in mind that the increase in 21 equity levels came at a time where stock prices for many companies had recovered, even surpassed pre-COVID levels. And this in turn made dollar-based grants, which remains the leading practice, more affordable since fewer shares were required. And that dynamic will matter as we head into 23, which we'll talk more about soon. Looking ahead, at a minimum, we expect to see a modest softening of ongoing pay levels across the market, with the potential for more substantive reductions in equity in particular, if the current economic downturn continues heading into the first quarter of 23, which is when most companies will be making grants. In fact, looking at the situation on the ground today, we're already beginning to see companies resetting how they define strong retention hold going forward. So typically that's defined as a multiple of salary, and those multiples of salary are now coming down. Similarly, we're seeing reductions to new higher grant levels. So that could come either in fewer outlier exceptions to bring on great talent, or just in general granting on the lower end of market guidelines. On a similar note, there's emphasis on cash delivery, where the balance sheet, of course, allows for it, and that's coming either through salary, bonus, or having long-term cash versus equity to help manage dilution. And also we're seeing discussions of moderated to flat pay increases for 23, recognizing that it's still early on, halfway through the year. We'll come back to these dynamics and their implications more when we take a deeper dive into emerging topics and trends later on in discussion. But for now, I'll hand it back to Matt to discuss pay mix and incentive plan design.
Thanks, Rami. So yeah, now we'll be talking about the incentive plan and mix for both the short and long term as observed among the TSX60 constituents. So starting with the STIP design here, we show kind of the average corporate STIP mix. So among all 60, what that mix would look like. It would probably come as no surprise that the most common metric is that of some form of financial metric, whereas 55 of the 59 companies were using this. Next in prevalence was ESG, which has now become a large part of many companies' STIPs. This year, 37 companies in the TSX60 incorporated an ESG metric in their STIP with an average weighting of about 14% as a whole. Next, we see operational and strategic metrics still having a place in the STIP, but we note that the kind of increase in ESG kind of had to come from somewhere, so we often saw a reduction in financial or, of course, these other strategic or operational metrics. To the right, we show some of the most common metrics used among these scorecards in different buckets, if you will, so such as earnings or cash flow for financial, safety or employee experience for ESG, and so on. More interestingly, at the bottom here, we show kind of the average number of metrics used in a corporate scorecard. So this hasn't changed much year over year, remaining at 5.5 metrics used on average. However, what is important to note is that the average actual corporate score was 133% of target, and this is compared to the 96% we saw in 2020. So again, this drives home the point that it was a strong year, and therefore actual compensation was likely higher. And from here, we can deduce that a large portion of that was likely paid out in the STIP. Lastly, when it comes to the use of discretion, because the average actual score and performance was so strong, it's not surprising that the use of discretion decreased significantly, being used in only 14 companies STIPs this year compared to 33 last year. And again, last year there was a lot of COVID impacts that had to be considered as well. So we were expecting a large use of discretion last year, and then that to kind of drop off to what we would expect to be more normal levels this year, which is the case. Moving on to the long-term incentives, there were minimal changes kind of year over year in the actual CEO average LTIP mix, so that being options, PSUs, and RSUs. We do show here the 2016 average mix and the 2021 mix because we feel like it gives a better picture of kind of what's really happened and how things have evolved kind of over the recent past. And what you can see here is that kind of distinct drop off in the use of options, and then instead we've seen the increase in PSUs and RSUs. However, the use of options hasn't really decreased significantly in the last couple of years and has kind of seemed to find a home in the around 25% mark. With that being said, there are still companies in the TSX60 that have either decreased the weighting of options in their LTIP or have removed them entirely, either for 2021 or they've announced to do so in 2022. So an example of a company removing options entirely would be Fortis. And then examples of companies that have just decreased the weight, usually to around the 25% or 33% mark, are Synovus, Dollarama, Nutrien, Pembina, and then Power Corporation of Canada. Our last note on stock options is that while these changes in the options, specifically what we just mentioned in these companies, were likely accelerated or influenced by the stock option taxation changes that recently went into place, we don't see a kind of major correlation or direct impact of the stock option taxation rules that have kind of reduced the use of options. For most cases, options were already being phased out and the change was maybe an accelerant, but was by no means a direct driver. Now, when looking at PSU metrics specifically, relative TSR remains to be the most prominent, being used in 71% of the company's PSU programs. And then we see the use of return metrics decreasing. So in 2020, this was at 39%, and now it's decreased to 31%. Now, this slide shows the actual total direct compensation mix for the CEOs over the last 5 years. I think this is important to see just so we can picture how much at-risk pay a CEO has and how that's evolved, as well as how much cash versus equity. So in 2017, you can see that there's a much larger weighting towards base salary and STIP than there was kind of, let's say, in 2020. However, in 2021, we did see the resurgence of a larger STIP figure. Again, this is actual pay. So because of the very strong performance and above target scores, this isn't a surprise. We do suspect that this number will decrease in most sectors for 2022, given current market conditions. But of course, for something like energy, this may only increase based on actual performance. With that, I'll hand it over to Rami, who will discuss some LTIP trends that he's seen in the US.
Thanks again, Matt. For long-term incentive design in the US, I would say it remained largely similar year over year, although we do expect changes for 23, just picking up on what we're starting to see now in active discussions and also building off the trends in 21. So to start, relative TSR metrics are now actually on the rise after years where they've been coming down or at least have stayed flat. Relative TSR, of course, was at one point very popular due to the lack of hard goal setting that's involved, and companies continue to struggle with setting 3-year financial targets. And you can imagine that that only becomes even more difficult in the current macroeconomic environment. So we saw an over 10% increase in prevalence in the past year, and we expect that trend will continue heading into 23. Performance periods remain at 3 years, and we expect that'll continue to be the case, certainly as a leading practice, given the expectation by proxy advisors and other external constituents to have a true 3-year period. At the same time, just like in a minority of cases in 2020 and to a lesser degree in 21, we saw companies shift from a true 3-year to either 3 1-year periods or having a 2-year on a financial measure and then 3-year modifier for relative TSR so they could help get that 3-year credit. Those are practices that we could continue to see an uptick heading into 23. Pay levels, and specifically the threshold and maximum payout levels around target have remained at 50% of threshold, 200% at maximum. And certainly at maximum, we expect the 200% to hold. The 50%, I think, is always an interesting question for companies to think through in periods of distress or uncertainty more generally, in terms of how you set those curves and whether you have a lower threshold to make sure that there's some payout opportunity, even if the environment is proven to be challenging. And lastly, and on a similar note, the financial measure performance ranges, and this is particularly for companies, and most companies do measure bottom line measures in their annual incentive plan. You typically see a range around target of 80% at threshold, 20% at maximum, so 20 points around target. Though that range, we expect to remain at that distance at a minimum. Although again, in this environment, it's very typical, and we would expect to see expanding beyond that range, whether it's to 25 or even 30 points, just to provide companies with a, I'll say, softer landing in case that they either miss on the downside, but at the same time, it makes it harder for them to achieve on the upside. And so with that, I'll hand it back to Mac, who will speak to the 2022 Say on Pay results.
Thanks. So yeah, we'll now be talking about the 2022 Say on Pay results for the TSX Composite Index as a whole, not just the TSX60. So to date, we've collected 125 Say on Pay results for these companies. So far, the 2022 proxy season saw a decrease in Say on Pay results over 90%, as well as under 50%, with an increase between that kind of 80 to 90% zone. And then things have remained flat between 50 and 80%. Here we show some notable companies that received Say on Pay results under 80%, but it's also important to note kind of the strong performers that have maybe had a strong increase from last year to this year. The standout this year being Gildan, which increased its vote from 41% to 92%. On this page, we break down the average Say on Pay result for these 125 companies by industry. Overall, the results are kind of varied by industry, with materials and financials being the only industries to post year-over-year increases in the average score. This is most notable in the financials industry, which has increased from 89% last year to 94% this year. Whereas all the other sectors, again, besides materials, have so far seen decreases. But it's also important to note that the Say on Pay season is not necessarily over just yet. Rami, what are you seeing for the current US Say on Pay results?
Sure, thanks, Matt. So we're seeing a failure rate at roughly 2.5%, and that's consistent with historical failure rate levels. I think what's interesting is if you dig into the details a little bit, you're seeing a diversion in outcomes with the S&P 500. They're actually receiving a lower average vote result by roughly 2.5%. And to us, that suggests that shareholders are more highly critical of pay programs for large companies, and in general, those companies are receiving more scrutiny as of late. And if you look at the 37 failures to date, 12 of these failures, so roughly 1/3, are S&P 500 companies. And so that seems to confirm that hypothesis. By sector, the bottom chart, you could see that energy companies are leading the pack. And in some cases, that's due to pay quantum, which is a theme that we'll talk about more in a moment. And turning to the next slide, when we look down at the Say on Pay results, focusing on the ISS angle, so the against recommendations by ISS are just over 10%, and that's in line with 21. At the same time, if you were to drill down into that 11%, you're seeing a slightly higher proportion on the against recommendations for large cap companies, and that's showing up in that lower vote support, which we mentioned earlier, that 2.5% differential. And then tying it all together, looking at the emerging themes. So first, again, there's that spotlight on large companies. We don't think that's a passing trend. We think that'll continue. And so it's important, if you are a large cap company, to keep that in mind as you're thinking through pay decisions, particularly pay decisions that would relate to either mid-flight changes to incentive plans or just to pay magnitude, any one-time special awards, particularly at the CEO level. Those are items that ISS has and always will be critical of, but even more so now with large cap companies. And then the last item, moving away from pay and focusing on ESG for a moment, the rate of ESG proposals with passing support actually decreased relative to 21 levels. What we are seeing increased support, it's really more for those broader environmental reporting proposals. So for example, reporting on your carbon emission levels, as opposed to requesting a specific change to the company incentive plan or strategy. So having a specific ESG measure introduced into the incentive plan. So we have not seen that yet. Again, we think that's probably a slower emerging trend that we'll continue to monitor.
Great. Well, now I hand it off to Kiera to talk about kind of the board effectiveness portion of the webinar.
Great. Thank you, Matt. Well, when it comes to board effectiveness and the disclosure of board effectiveness practices, it's certainly becoming more prominent in the TSX60. In fact, it's probably fair to say that at this point it's table stakes. All except one firm on the TSX60 disclosed their board effectiveness practices, and even that one made a point of making promises to do better next year and to undertake more in the next fiscal year. We're at a time when governance committees are really getting their turn in the spotlight, much like how audit committees did years ago, and then HR and comp committees got their turn with say on pay. And now governance committees are really getting a lot of attention from stakeholders really across the board. So when we look at what gets disclosed in the proxies, well, board evaluations, of course, are the big theme that's coming out, and those have been there for a while, but we're starting to see more commentary around how it's done, what gets covered, the actions that are coming out of that. And we'll get into that on the next page. But some of the other things that we're seeing as it relates to board effectiveness would be board composition. Of course, skills matrices have been in there for a long time, and that's quite table stakes too. And then some firms are starting to talk about other board effectiveness practices, things like CEO transition, CEO search priorities. So that's probably the big trend. The second trend is that perhaps in light of all of the attention on governance committees right now, they're seeking help from third-party service providers. So 43% of the TSX60 disclosed the use of a third party to support their board effectiveness endeavors in the past year. And this was our first year tracking board effectiveness reporting and disclosure on the TSX60. But if we look at trends on the Fortune 100, we can probably expect to see an increase in these. So what you see on the right of the page is even just 3 years ago, 1 in 5 boards were using external support, and now it's closer to 1 in 3 boards. And so we expect that that'll be a trend in the coming years as well. If we dig in on the next page to what actually is included in board effectiveness evaluations, this really gives us insight as to what is top of mind for governance committees. And about 50% or nearly half of the TSX60 companies did disclose what they're looking at in their board evaluations. And so board composition, again, this is not new, but it remains a really key priority for governance committees, particularly with a huge social dialogue on diversity, lots of dialogue on skills, experience, competencies, provenance, diversity, and so on. Boards are looking at the structure of their board. You know, do we have the right committees set up, and have we scoped and structured work in the right way? And so that's something that boards are introspecting a bit about. Board procedures, so meeting structure, agenda planning. This has been a really big theme lately. Really, boards are trying to ensure that they're creating space and the right agendas to hit the right level of depth in their discussion and really create time for a rich dialogue in their meetings. And no doubt the virtual setting over the last couple of years has posed a bit of a challenge in that regard. To call out another few, succession planning, risk management, but relationship with management has been a big dialogue as of late in board effectiveness. I think without the dinners and the coffees that bookend board meetings, some of the intimacy between board and management has been lost, and there's an effort to regain and rekindle some of that relationship that can really only be created when humans are in the same room together. And so we're seeing a lot of effort around governance committees and putting their mind into how they can enhance the relationships, not only with management, but amongst the board as well, and perhaps all the new board directors that have onboarded in a virtual world. To contrast that with the Fortune 100, over half of the Fortune 100 companies are disclosing what they talk about and what they're looking at in their board evaluations. On the next page, we can think about the tools. And so we're seeing an evolution of how boards are undertaking their board assessments or their board evaluations. I think for a long time, surveys have been the key tool in discovery. But as of late, we're starting to see a greater focus on the qualitative context that goes around those surveys. And so as you'll see on the left, many boards are using interviews to complement their the survey data that they're doing in their board evaluations. And this tends to end up with much richer outcomes and action items that come from board evaluations. In the middle column, you see that 26% of boards on the TSX60 used upward management feedback in their board evaluation. And this is a trend that we're seeing led by, of course, 5 of the 6 big banks, Manulife, Sun Life, CP. So it's becoming better practice and more common to be asking for feedback from management on how the board is adding value to the organization. Finally, what we have on the right is actions. So while only 5% of the TSX60 companies actually talked about their action plan and what they're doing as a result of their board evaluations, on the Fortune 100, about 1/3 of companies are doing that. So I expect that in Canada, we'll start to see more of a trend towards some of the actions and initiatives that are coming out of it. In research that PwC did recently, it turns out that about 28% of board evaluations are dead ends, as in nothing comes from them. And so it's really important to ensure that boards are creating these action plans and adhering to them. I'll pass it over now to Michelle to talk about emerging trends and topics.
Thanks, Kira. And maybe before I get into those topics that are on the page here, I'll remind all of our viewers to submit any of your burning compensation or board effectiveness questions using the chat feature on the top left-hand corner. So as you'll see on this slide, we have identified 3 topics that are currently top of mind for both us here at Hugessen and Semler, as well as the director community. And you'll notice that the first topic is ESG, and certainly if you've tuned into either our past proxy season reviews or the webinar on June 1st, You'll know that this is a key trend for a number of years, and one that's had some proven staying power, as it's really remained top of mind for the last few years for a broad swath of stakeholders, management teams, as well as directors. And so, as I mentioned, we did host a webinar on this topic specifically in depth, and it's available on our website if you'd like to take a look at it. With that said, I will call out a couple of key highlights on the ESG and compensation world. And probably the first and foremost is the fact that the use of ES in particular in pay programs really has continued to increase in prevalence, and it is now included in some capacity or in some weighting in 75% of TSX60 company pay programs. And while it is more common to see these metrics in the short-term incentive program, we are starting to see its incorporation into the long-term equity programs. And you'll note that this is all at Canadian Natural Resources, CapREIT, as well as a number of the Canadian banks here. And then finally, I would highlight the use of some leading performance metrics, particularly in the emissions reduction and sustainable financing segments. And this has become much more prevalent this year, 2021, and is now included in 25 companies, either in their short and or their long term. And this is up significantly from 6 companies in 2020. Looking forward, I would say the focus of ESG is expected to continue, and we note this as both regulators on north and south of the border have proposed significant regulations that are out for comment at this point in time. The second topic that we wanted to raise for everyone is this war for talent. I don't think this will catch anybody's surprise, and I want to talk about it specifically in this inflationary environment that we have in front of us. So in 2021, there is a substantial amount of competition for talent, executive talent, and a significant run-up as well in what we're seeing in terms of competitive pay, both at the junior and the mid-levels for a lot of organizations, particularly in a couple of sectors, those being finance, tech finance, and law. Excuse me. And so we're seeing this increase in pay paired with the inflation, having basically companies trying to increase pay levels or thinking about increasing these pay levels throughout the broader organization. This is really to avoid any undesired pay compression and also to maintain the competitiveness of the overall compensation programs at that organization. And so we do think that some companies may view this as an opportunity on the flip side as a soft landing or maybe even just a plateau for where the historically significant median worker to CEO pay gaps have existed and whether or not they can be narrowed going forward. Philosophically, this really is going to come down to whether companies want to review the extent to which this pay gap could be narrowed or if it should just be continued and maintained. To add to the increased wages and inflation, we're also now operating in an environment of weaker equity values. So the market really is coming into play for the long-term equity incentive plans. And so companies are having to determine how they approach the LTI programs in this environment and may need to consider a number of factors. Some of these could be the pressures to which the current equity at these weaker values is putting the pressure on the Treasury Reserve, so the number of the shares in the reserve pool. Even whether or not the eligibility should be curtailed, either sort of limited in the number of participants or the size of the awards. There's also the question about whether or not you can, from a grant date for value perspective, be cutting back on sort of the number of shares that are going out from the plan. Obviously, these discussions are not necessarily new, and for those in certain industries, they'll have been working through this in the highs and lows of their cycles. And we've seen that the long-term incentive plan and the equities can really be impacted in the oil and gas space, so really riding through that cyclical process right now, and seeing that this current environment may lead this into some of the other industries that are out there across Canada and North America. I'm wondering, Rami, if you could share what you're seeing in terms of the war for talent and the current macro environment south of the border.
Sure. I think what's interesting about the war for talent is to what extent the war for talent may be coming to at least a slow temporary pause, if not an end. You have a reality now where companies, even a few months ago, were willing to entertain the notion of paying outside packages to either recruit or retain talent. And now several of those companies have gotten to a point where they're going through reductions in force. And so in that context, even retaining becomes a much more challenging notion. And on the other side of the coin, those folks that may have had exit opportunities a few months ago, those exit opportunities may no longer exist, or if they do, they're much less attractive. And so, it seems to me, and, based on our observations in the past month, that we expect that many may opt to remain with the company, see that as the best opportunity to help drive the turnaround, bring their equity in the company back to normalized levels. And, looking far ahead, it could be that we'll get back to that place that we were for the past year and a half. But I see that having a slowdown and a pause in the near term.
That's great, and good to know that there may be some light at the end of the tunnel for some of the companies here in Canada who are still working through this war on talent. Our final emerging topic is really the current geopolitical conflict between Russia and Ukraine, and some of the broader macro items that are happening because of that. And specifically with regards to the extent that management's decisions to either maintain or remove some business operations in Russia, and how that really could or should impact the year-end compensation decisions and the performance results that those companies are experiencing. To that end, I'll bring you back to the end of 2020 when COVID first started and similar questions were raised. Obviously, there will always be times where the business is impacted due to the circumstances and the context outside of management's control. And the board and committee will, together with management, really have to assess the situation on a case-by-case basis to see how, if and whether compensation could or should be changed to reflect some of these outside factors. As those who've worked with us in the past, in our view, there's obviously no single right answer on how to approach this particular topic, but we really do recommend that committees and management teams are transparent in their approach internally and as well as the communication externally, and that all of this start as soon as possible rather than later. I'd also sort of note that even for those companies that don't directly have operations in Russia or the Ukraine, they may be impacted either positively or negatively from knock-on effects such as increased commodity prices and even challenges just with supply chains that are out there. And so really the takeaway here is that in preparation for those year-end decisions, the recommendation really is that boards and management teams are probably going to want to come together and discuss these scenarios, the context, and the impact on results early and often. The communication and the eventual disclosure on how these impacts were considered really do generate sort of a view in terms of how effective the compensation and the governance of that compensation program are. And you're likely to find easier conversations with your institutional shareholders and or the proxy advisors should they come out with a viewpoint of their own. So with that, I would say that this concludes our presentation and the formal part of that. And I'd like to move now to our Q&A. So I'll again put out the request to all of our participants. If you do have any questions that have come up, please do submit them. And with that, I'm going to kick off with a couple of the early ones that came in. So I think, Matt, the first one, I'll sort of head to you, and certainly Rami, if you'd like to chime in with a US perspective, by all means. So we've got a question here in terms of what we're seeing in terms of mid-year salary budgets. I think we've had a couple of press releases from some of the Canadian banks and what they have done. And so what are we seeing across the board out there? Matt?
Yeah, so far, especially among our client base, I think we've seen most of these mid-year increases for kind of start in July to be upwards of 6 or 7%, which is in line with inflation, but still a big difference than kind of the 2 to 3% we were seeing kind of in the past couple of years. But yeah, it's in line with kind of the news releases that have come out with the banks at about 6 to 7%.
In the U.S., I would add also seeing roughly 3 to 4%, and we actually conducted a survey towards the beginning of the year. At the same time, it'd be interesting to do a refresh of that survey, just given how much has changed in the past 6 months, and particularly inflationary pressure. So I wouldn't be surprised if we see some of those numbers err on the high end for companies that have the balance sheet to support it.
And maybe, Rami, on a related note there, you certainly touched on the pay levels in the US in the earlier content. We've got a question here sort of following in on this, the loosening of the purse strings in the last few years in terms of pay levels going over the longer term, maybe. Any thoughts there?
Sure. As I reflect on the current environment and just think ahead to the proxy disclosures in 23, it seems to me that many will have a flat target pay increase. Particularly if you go back to 2020, and there are companies that went through reductions in force, and there was an expectation early on at that point that pay levels were either coming down or remaining flat. I think we'll see a repeat of those dynamics. I think where you do see pay increases, it'll probably be nominal increases to salary, flat target bonuses, and then I would say flat equity, particularly if equity prices remain depressed at that point.
That's great. Thank you. And a question for you, Kira. On board effectiveness, we've got one. How often do you see peer feedback as part of the board evaluations that you're completing?
Yeah, that's a good question. I mean, I think it goes without saying, first of all, that feedback is an incredibly valuable tool that we use throughout our entire careers. And then when we get to the boardroom, the dynamic's a little bit different because you're among peers. And getting peer feedback, it still is incredibly valuable, but it comes with a different level of comfort. And, I think it takes practice for boards to do it. I think it takes a few years before boards have the trust and are able to do it really well and give each other really good feedback. So I am a proponent of partaking in peer feedback. I think it can be incredibly valuable as a practice to really help directors develop and in turn boards develop. We are seeing that more and more boards are trying it. I think there's ways to ease into it. It might start with, for example, self-assessment. Or it might start with feedback through the chair or the committee chairs, and then sort of evolve into peer feedback. So we are seeing it. It's getting more traction. It's a great tool.
Great. And I've got one final question here that's been submitted. Maybe a little bit unfair, but I'll post it to you, Matt. Rami, feel free to chime in as well if you've got any viewpoints. But this one is specifically as it relates to the energy industry. And I'm sure we can apply this to any that have these windfalls. The question is, what should companies be doing with the windfalls and the cash that they're currently generating?
Yeah, I mean,
Matt, do you want to take a run at that one?
Sure, yeah. I think this is an interesting question, I guess, because usually when we hear about windfalls in our business, it's more so how do you compensate management when these windfalls occur. As far as what to actually do, when the windfall happens and the cash they're generating, I think we see a lot of different examples, mostly about kind of either holding it for reserves in case, there's uncertainty and then they'll spend it later. But I guess one of the more innovative uses, I guess, of this cash that we've seen recently or that's been in discussion is the investment into R&D for, say, a traditional oil and gas company to move more into the renewable and clean tech. Obviously, this would help with kind of the ESG initiatives, hitting climate goals, and also just evolving the business to stay current. But in the context that I'm specifically thinking of, a huge reason for this investment was actually a strategic play to attract the younger talent who they would think would then lead the company in the future. A lot of the younger talent, it's probably no surprise, is more attracted to the renewable and clean tech side of energy rather than the traditional fossil fuels. And while that's not always the case, it's nice that a traditional oil and gas company could have that option to kind of get the talent that would be attracted to that. So I think that's probably the most unique case, but also very interesting, because not only is it helpful for the business in the short term, but also for the long term, kind of attracting that talent. And then from the talent perspective, of course, they may be more attracted to go to a company where they can work on a new venture in one of these areas that's kind of very important to them.
Excellent, thank you. Remy,
And I would add,
I
would add maybe from focusing on the pay side of the coin, we see an interesting dynamic across our clients where in some cases you had a blowout year in 21, and that was received or communicated in one of two ways, or this was a great year, let's keep going, or a slightly different but important nuance, this was a great year, really looking at it, this was an extraordinary year historically, and let's not take that for granted. And I think that latter approach has really been helpful for those companies who unfortunately had a reversal in 22, where they had the great outcome in 21. Maybe there was some recognition that it was a pretty incredible year for most assets in 21. Not to take away from the company and individuals' efforts, but to be sure there were certainly tailwinds there. And applying that messaging to 22, where there's a certain cyclicality for some companies and certainly some industries more so than others. But it's important in general just to help balance that messaging to weather these storms when they do occur.
Fantastic. Thank you all. That takes us to the end of the questions that I received through the chat function at this point. It takes us to the end of our session on this webinar here. If you do have questions that have come up sort of in the last little bit here and you haven't had a chance to submit them yet, please don't hesitate to reach out to any of our panelists here or to reach us at email@hugessen.com. I'd really like to thank you for all attending, and certainly last but not least, I'd like to thank all of our panelists for sharing their insights today. Have a great day and be well.